It is indeed the Buckeye edition of Startup Monday today. But before we get into that, we're going to first take a look at our top business stories that are moving markets at the start of this new week. And the first of these, a trading statement earlier on this morning coming from ShopRite Holdings. And they reported a 7.3% increase in their turnover for the 3 months through to September 2019. The group's core business, which is the supermarkets offering here in South Africa, grew sales by 10.3% during the quarter, continuing its market share gains, and also internal selling price inflation measured at 3% in the period. And to give us a bit more analysis on this particular story and many others, I'm joined in studio now by a market analyst at Axi Trader, and that's Jimmy Moyaha. Jimmy, afternoon to you and welcome once again to Business Unusual.
Thanks for having me, Aya.
ShopRite, it seems some tough going here outside of the South African market, and a lot of the, I guess, backlash to the xenophobic attacks that we had here in South Africa weighing heavily on their revenues, in particular in the Nigerian market.
Definitely. I mean, the Nigerian market accounts for quite a bit of the Africa revenue as well. You'll see that the market was down about 4.9% in that respect. And that's, yeah, as you said, largely due to the xenophobic attacks, the negativity around that. But also, as a whole, ShopRite has been sort of struggling on the African continent. South Africa seems to sort of still be its most profitable country on the continent. But within the rest of Africa, it seems to be going through a bit of a tough patch.
But it's a tough consumer demand environment. Households are squeezed, heavily indebted, and we start to see this, certainly when it comes through in the retail numbers. And yet 15 new stores have been opened, including some in the a more lower income segment of the market, USave and ShopRite, and even the Ekasi offering, which is a slightly smaller format store. But what do you make of some of that for in light of depressed consumer demand and the debt that we saw on their balance sheet the last time they released their results?
Well, I mean, for ShopRite, if it's one of those situations where if they fall behind in terms of not being able to identify where they can get the maximum revenue. You've seen Pick n Pay's also ventured into a similar sort of scale of targeting your township areas, targeting more of your less developed areas in terms of getting market share and opening up new stores in those regions. Those guys do account for a sort of a lower LSM bracket, but you're getting more frequency in terms of the number of trips to the store and that sort of thing. I mean, obviously it's going to weigh, the retail sector is going to suffer. It's going to weigh heavily on them because there's less disposable income in the market for all of us.
Yeah.
And so that's definitely going to affect everyone. And you see ShopRite and you see Pick n Pay coming up with these new ways to see how they can keep the revenue coming in the tough economic climate that we're in.
What's your view, Jimmy, on their loyalty program, that extra saving rewards program? And they came out early on this morning saying the sign-up has exceeded their expectations. I mean, a million by way of sign-up in just under a week or so. I mean, that speaks volumes about their store footprint and I guess, you know, the role in the hearts and minds of many consumers.
Well, I mean, if you look at where the program sort of sits, it's similar to your Smart Shopper program. It's similar to your Woolies W Rewards program. The only difference with sort of ShopRite's side of things is they've got a bigger sort of, as you said, a bigger footprint of stores they can sort of roll it out with. They've got the Checkers group, they've got the OK guys, they've got the USave guys. And if you're going to look at those three different brands, they sort of target three different groups, market segments as well. So when you launch a program that caters to all three market segments, they launched it a while after Smart Shopper and a while after W Rewards, but you saw from the response that they got that it wasn't too late. And I mean, one of the benefits on their program as well is they've got something that allows you to get instant cash as you buy your groceries and that sort of thing. So that's definitely, it might give them a bit of an edge in that sort of thing. But I mean, every consumer is looking to save wherever we can in this day and age. Everything's just so expensive. Inflation's also just not helping our situation. So we're all looking to get that little bit of extra buck for our rand as well.
Yeah. Just before we leave ShopRite, I mean, we touched on what happened in the Nigerian market. I'm also quite interested in their performance in other African markets outside of South Africa and the impact that devaluations in key currencies have had here for ShopRite and more importantly, what they flagged in this trading statement in that regard.
Well, I mean, as you said, from the currency devaluations perspective, you're looking at a lot of geopolitical factors and economic factors affecting these African countries. And so the the devaluation of those specific currencies that are traded in will definitely result in less consumer purchasing power being available to the consumer at the end of the day. And so the cost of goods not necessarily increasing from a ShopRite perspective, but the affordability of the goods increasing because of the value of the exchange rate decreasing. So from that perspective, I mean, it's interesting to see how ShopRite's going to combat that, because on an African scale, they've got all of these foreign currencies that they're dealing with on that scale, and that's their weakest market at the moment. Are they going to use it? Are they going to optimize it by closing down some African stores and focusing more on the SA business? Are they going to continue the expansion into Africa? I mean, we've recently seen a couple of guys come out, including property giants, come out and say that the African expansion plans that they had from their perspectives didn't go as planned.
Sure.
So it's interesting. We'll see if ShopRite's going to experience the same thing, if they still believe that they can extract value from their African markets. But they've got the business model to do that. They've got the segments to set it up if they need to as well.
Let's talk about some of those internal cost savings. I mean, one of the things, as you say, that has always made ShopRite put the rest has certainly been their distribution model and the ability to contain costs, which in many instances allows them some advantage on the consumer side of things, because they can be able, product for product, to be able to undercut many of their competitors. Has that come through strongly here? I mean, if we look at a turnover increase of around 7.3%, what does that tell us about, I guess, the cost environment and, more importantly, potential operating profit?
Well, I mean, the turnover is a very positive number. Sales were up about 10% as well, as you said earlier. And if you look at that in relation to the fact that the cost of doing business amongst the group itself, that increased by about 3%. So that they're keeping that cost down as much as possible. It is a bit of an increase from the previous numbers that we saw, but I mean, they're still keeping tabs on that very heavily, and they're using that to drive greater revenue and to drive a better turnover. So I mean, I think their systems and what they've got in place in terms of how they internalize a lot of their business is going well for them at the moment.
Okay, let's take a brief break, Jimmy, and when we come back, I want us to take a look at some sovereign matters here. Ratings agency saying to Tito Mboweni he's got a quarter before, I guess, or to deliver a credible plan to turn around some of the SOEs and even give some direction on how we're going to resolve the debt challenge at Eskom, so that we can avoid junk status before the 2020 February budget. So we'll take a look at that, and more importantly, I guess, what this now means for not only the National Treasury and the Department of Finance, but South Africa Inc. as a whole. Let's take this brief break, and on the other side, we bring to you more top business stories. Do stay tuned to Business Unusual right here on Newsroom Africa Channel 405. Welcome back. You're watching Business Unusual here on Newsroom Africa Channel 405. We're still taking a look at our top business stories that are moving markets at the start of this new week. I'm still joined by Jimmy Moyaha. He's the market analyst at Axie Trader. And Jimmy, ratings agency coming out here and saying Tito has 3 months to find a savings of 150 billion rand and stabilize the debt situation at Eskom, or else we're going to face junk status by the 2020 February budget.
Yep. And that's one thing you don't want. I think that's the one thing that, as a nation and as an economy, we really can't afford it. Not just from a economics and physical standpoint, we actually physically cannot afford it. If we get regulated junk status, you'll see that we'll probably lose about $15 billion in investments as the sell-off begins in South African investments. So we actually cannot afford to go into this situation.
What is it also going to mean, Jimmy, for our debt service costs? I mean, we heard the Minister of Finance saying we're hovering around that 60-something% point now when it comes to debt to GDP. But if GDP doesn't improve significantly, and we have to borrow for the same expenditure profile that we have, we might find ourselves at 70% by 2022, 2023. What does it mean to be sitting in junk for our cost of capital and our ability to even go to capital markets to raise some money to fund our expenditure?
Well, I mean, first of all, if you're going to be at junk status and then you're going to want to seek out additional capital investments from capital markets, particularly foreign direct investment, you're not going to get anyone coming in to invest on that front. Your cost of existing debt is going to increase astronomically because you're no longer then able to service that debt in the same manner that you were previously. Yes. So the overall effect and the ripple effect that'll have on the economy will be quite disastrous, not just from an SOE point of view, but from our economy as a whole, yeah.
And of course, I mean, if we continue to see that picture, we'll probably see the trend of debt service costs crowding out social and economic spending becoming a bit more pronounced?
Definitely. I mean, in as much as the midterm budget speech that came out was geared at enhancing economic growth and improving those sorts of areas, the reality is the government needs to seriously look at cutting back on debt. There's no point in increasing your economic growth if you're not managing your debt, if you're continuously borrowing, if you're continuously bailing out SOEs like Eskom. It doesn't matter how much your economic growth increases by, as long as you're incurring more debt, your debt to GDP ratio is still going to be high.
And it's unclear. I mean, you know, debt for debt's sake sometimes isn't wrong. I mean, if you're investing in, if you're getting that debt for investment purposes or for capital expenditures that can give you second, third, fourth round effects and give you a return on your investment, then it's okay. But I get a sense that there isn't a really clear plan about what we're borrowing for and more importantly, what returns we anticipate from that. If we're borrowing to sort of help out power stations that were newly built and sort out some of the issues there, then one gets a sense that we're probably sort of putting good money after the bad.
Well, you'd think that would be the case, but I mean, if you look at what Eskom's gone through, I mean, in the last 10 years, their employment or their employees have increased by about 23% from 2009 to 2019, yet their output of electricity is actually decreased by almost 4.5%. So we're employing all of these additional staff within the Eskom team. What is it that they're doing? We're incurring costs to pay these individuals for their expertise and that sort of thing, but the output of electricity isn't showing that as a result. And that can be said for a lot of SOEs that we have within the government. We're bailing them out, but we're not actively turning them around. It's sort of, we're just delaying the process, kicking the can down the road and saying, you know what, we'll cross that bridge later. We'll look at that when we get to it later. For now, let's get another bailout in place. And that's really not a sustainable strategy.
Yeah.
That's really a concerning strategy. And unless our minister comes out with something drastic in the February budget speech where he's given the time to do that, we could very well see ourselves being relegated to junk. I mean, the other two ratings agencies have had us on junk since 2017. So if this happens with Moody's, then this is our last lifeline that we're sitting on at the moment. So this is time for some seriously drastic change, and not only policy announcements, not only plans, but for us to actually implement them.
Sure.
So often our government makes these announcements, they make these pronouncements and they say, these are the plans, this is the fiscal strategy, this is what we're going to do. And then come time for implementation, that's it. See?
Yeah.
Nothing.
You touched on something here, Jimmy, around personnel, right, and making the example of Eskom. But we know the second largest and the fastest growing expenditure item on our public budget is wage costs, and that is the public sector wage bill. What is the likelihood politically, or even the feasibility, of being able to get a deal with some of the public sector unions prior to that February budget?
Well, I mean, from a public sector union's perspective, the union is always going to want to protect their members at the end of the day. But I think it's time that the unions also then realize that this is not the time to be focusing on that, but rather focusing on the catastrophic effects of what a downgrade could mean for our economy. I think it's time for us to start looking at the bigger picture and not looking at a situation where the unions are just saying, no, we need to ensure that our staff are catered for, our members are looked after and that sort of thing. Because at the end of the day, if we get downgraded, if things go that badly and that pear-shaped, then the unions might not have members to be a union for. So at the end of the day, they need to also look at it and say, we're at this point, it's a crossroads for everybody and for us as an economy, and we need to make a tough decision. Some might not like the decision, but it's for the greater good.
Now, Jimmy, the other thing I want us to take a look at as we shift away from the sovereign image is some of the work that the JSE has had to do here with many errant companies. And I say errant here because they haven't been submitting their financials in good time. One now has been suspended, and that is IT company Foresight. They dabble in the world of artificial intelligence and all manner of other exponential tech. What's happening here? And we know that Foresight isn't the only company that has given the JSE some headaches when it comes to whether their results are timely or lack thereof.
Well, I mean, if you remember a couple of months ago, there were some rumors around whether or not we should have our JSE listed, how the JSE is viewed from an external standpoint from foreign investments and that sort of thing. And so you'll see that in their aim to ensure that they provide sort of the highest of quality of standards from their side. They've had to clamp down on some of these things quite harshly. So they've identified Foresight for not having submitted their financials on time, their interim financials. From Foresight's perspective, they've sort of said, given indication that they'll have everything published by around the 30th of November, just largely because they've had a change in restructuring of their board and that sort of thing. So October saw quite a bit of a tough time for Foresight. One of their directors resigned a little while late, a couple of days after that. The chairman of the board resigned.
So it seems like musical chairs there. I mean, one of them even went back to her political ambitions in Mauritius.
Yeah. I mean, Foresight originally is headquartered in Mauritius, and they've got listing on the JSE. But since then, we've also seen 4 more directors resign, and that's what prompted the restructuring of the board. So by the end of October, we had actually seen about 6 directors resign, and so the board of Foresight then restructured and reconstituted themselves, and then came out and said, as a result of this reconstitution, we will then have our interim financials published by the end of November, so they're looking to expedite that process. But from the JSE's perspective, they've found that they're not technically not compliant at this stage because they haven't published them by the required date, and so they've suspended the listing. But they're also going after everyone else that is in the same boat. You'll
Likes
see
of
that,
Exponent. And
you'll see Exponent's also there. All Gold Foods is due to come up as well. So these guys have until the end of November to publish their normal results, as expected. If they do delay, we could see that they could also be suspended in terms of their listings.
We often hear from the likes of the World Economic Forum and many others about the depth and sophistication of South Africa's capital markets. And when you see many household names and listed entities here failing to submit their interim or even final results on time, what does that tell us about the state of play, not only in our capital markets, but even in corporate SA?
Well, I mean, to a certain extent, if the factors are beyond the control of the entity, that is understandable, that is reasonable, and that sort of thing. But, I mean, if we're going to delay on these sorts of things and not take these things seriously, that's not going to put us in good stead on the world stage. I mean, the World Economic Forum is expecting high standards of delivery from us, and we've set those high standards in the past, and we need to maintain those. And if our organizations locally aren't going to do that, then we're going to have a problem in terms of how we compete on the global scale, especially given where we are economically and looking at the fact that we need every little bit of positive news around our economy that we can get at the moment.
Oh, definitely. The other thing I want us to talk about for a second here, we saw from ICASA today, 5G. And a lot made, I guess, about the 4G licensing, which is long overdue, but the 5G coming in much quicker, sooner than expected.
Yeah, we actually weren't expecting an announcement on that at all, and that came out, and they're looking at rollout around second half of 2020 for all of these things. So we've still got a bit of time to see how that plays out and that sort of thing. I think that'll be interesting to see, depending on where the large bulk of our 5G technology is going to come from. If we look at what's happening with the trade war,
it's going to come from Huawei, man. If it's definitely going to come from,
then we need China to sort things out. We need China and the US to sort things out, especially Huawei, because some of their component parts they buy out of the US.
Exactly.
And with what we're seeing with the trade war at the moment, if trade war doesn't go as expected, we could push back our 5G rollout, and that won't be our own of our own doing.
I feel like, Jimmy, I'm starting to sound like a stuck record here. Every single time we come onto this show, we express some optimism about a looming trade deal here. And probably a few days later, I express my dismay and disappointment again. But it seems now that, I guess, the marketplace is really expecting a deal here to break this impasse between Beijing and Washington sometime in the near future. What is driving that optimism?
So at the moment, there was an announcement from sort of both parties to say that they are in the processes of possibly coming to a conclusion on phase 1 of the deal. So not the entire trade agreement, but what's going to sort of divide or decide this trade deal at the moment is going to be how Washington handles the upcoming December tariffs that they're supposed to impose. So China has basically said that they're looking to get into a trade deal. They're happy to get into a trade deal for what America wants. The US has said that they want China to buy a lot more of their agricultural produce. They want China to give them access to the Chinese financial services markets, and they also want China to ensure that they maintain a stable currency. And China's basically come out saying, look, the core thing that we want from all of these US trade talks is no additional tariffs to be imposed. And so that they're sort of lingering on, do we then enter into an agreement ahead of December, or do we drag it out until we see what Donald Trump says in December around those tariffs and then see if we negotiate an agreement? So we're all optimistic. I think from our perspective, because our economy and our currency are so largely politically driven and affected by what happens. An emerging market currency is always going to be affected by two superpowers going into the ring together. And you saw the rand strengthen today on the back of that positivity. I'd like to believe a part of that was because we won the World Cup, but...
Hey man, yeah, Siya Kolisi moving the rand there. Look, let me tell you, I'll take phase one of this particular deal because we certainly haven't heard any compromise or agreements coming in thick and fast on this one. So I'll certainly take whatever phase one deal or the prospect of that particular deal. But to Jimmy, we'll have to leave it there. Always a pleasure catching up with you. Jimmy Moyaha is a market analyst at Axie Trader, taking us through some of the top business stories that are moving markets at the start of this new week. Now, the Bakai edition of Startup Monday is up next. You can send us some of the questions that you might have or share some of your own sentiments and comments with us on our handle on @405business_. You can also send us your comments and questions on WhatsApp on 072-110-5584. And we go into Bakai Startup Monday on the other side of this break.